Gambling is betting on an uncertain future. So if I said, okay, we're going to buy the S&P 500 index fund today, I'll argue that that's gambling. None of us know what the future is. It may be enough. It may not be. We don't know. I would much rather use that same S&P 500 index fund, but I'm going to put some rules around it. I'm going to put some rules around it, why I'm going to own it, when I'm going to own it, when I'm going to sell it. And I can control that. But now I have a defined process. I have a known process that I could put around unknown data. And we basically want to own things that are strong when the markets are strong, but because of absolute momentum, it helps us minimize those periods when everything is negative. It can also tuck us into something that's safe when we need to be.
If you were to take one strategy to create your edge, we talked about not touching a strategy for 100 years, something like that, what would you choose and why? Welcome back to the Unpacking the Markets podcast. Now, before we kick off, can I please ask you to subscribe to this channel so that we can continue to grow and help traders worldwide? Let's get into it. I would describe you as a super systematic guy, but I heard on your interview on Max Convexity, you talked about the drawdown associated with human emotion. And I wanted to know, have you always been this systematic, or did you start out a different way?
No, it was really a discovery process of looking at what truly works in terms of managing money. And so, I got started very young, right out of college. And what I realized pretty quickly was that, most of Wall Street was based on selling product. I mean, that's how you got rewarded. And so it wasn't so much about managing money and who had the best returns. It was like who sold the most. And so I had to then kind of go through my own discovery of like if I'm not going to be taught by the firms I was being hired by, I had to kind of go out and do it on my own. Um, a lot of it came from reading books and putting things together. And it was kind of like during like the early 90s through 2000 period. So, and that was also when databases were first coming into play, right? Because, we didn't always have, the internet as we know it today. So, the very first book I ever read was that I give a lot of importance to is William O'Neill's How to Make Money in Stocks. But what I liked about it was that it was just a combination of fundamental, but also technical. And so, and it's still, I think, a very relevant book. In fact, it was the first book I gave my son to read. It was like, okay, if you want to learn about the stock market, you go read this because it's still very valid. I mean, earnings per share and sales growth and those kind of things still are important. But also buying at the right time. And I also like the fact that there's the M in CAN-SLIM, that methodology, which gives reference to the market. You have to be cognizant of what the overall market environment is. And there's periods of time where you really shouldn't be too heavy in the market, at least I think. Mid 96 also was when O'Shaughnessy published What Works on Wall Street, which was a nice introduction to factors. And so if you've read that book, then he talks about like price to sales, for example, was one of the factors that he went back in his databases and he looked at what contributes what factors were most the best in terms of returns, just using pure quantitative kind of data. And it was things like price to sales or dividend yield. And so that was kind of like an introduction to factors in terms of importance. But also, in the mid 90s, databases were popping up online. So you could actually now start to go in and the screens that I was doing. So the way I did O'Neill investing in the very early days is on Saturdays, I would religiously run to the post office. I would get the New York Stock Exchange Blue Book and the Green OTC book, and we'd thumb through those. And we were looking for the stocks that had the earnings per share growth, and we had certain technical patterns we were looking for, and it was very manual. And then eventually in the mid 90s, you could go in and basically build that same screen in a database. So that was kind of the origin of like beginning to use computer screening.
Yeah.
And then I got introduced to Dorsey Wright, which was, Tom Dorsey is very famous for his point and figure analysis.
Mm.
And it's kind of an old school approach, but it was interesting to me because he talks about like what determines the price of security, and it's supply and demand. It's really what it comes down to.
Yeah.
And what the point and figure charts do very, very well is they show you the levels of price support, the levels of and where demand is. And they also show you where distribution are. And if you just kind of point and figure charts slow down price because you're not plotting time, you're only plotting price. And so it was kind of an interesting new way of looking at price discovery and all. And another element that came from that was looking at market internals, which were bullish percents, is what he published a lot of. And he always kind of referred to bullish percents as barometers. But the more I started playing around with the data, is that I realized that they could also be turned into some unique kind of timing tools. And the concept is very simple. If we can measure institutional demand accurately, which we can measure like what percentage of stocks that are bullish or bearish by definition of point and figure terminology. And we get a percentage, which oscillates generally say between 30 and 70%, whatever. There's ways to plot that data that will tell us whether the demand is ebbing or flowing in the market. And a lot of times, if in an index price movement will disguise or mask what's actually taking place beneath the surface. So sometimes you'll get a very a decline. For example, at a market top, you'll start to see a decline in market internals, things like breadth readings, bullish percent readings, those kind of technical indicators. And price might continue on a little bit longer, but I would argue that in most cases that price eventually follows the internals. So I began to okay, so back to your original question, it was really kind of a combination of putting together a lot of different things. It was like technical, fundamental, and some different types of technical. It was like the point and figure. And then I got really into just doing very formulaic approaches. So we were doing a lot of ETF business in our client accounts back around 99, 2000. And so those lent themselves very well to very precise formulaic. And as we get into what rules-based is, I can talk more about how we use them. But so it was kind of this evolution. 90s was really kind of spent putting it all together. And then it kind of formed a framework that I still use today.
Yeah, wow. And it's interesting you bring up those point and figure charts because I saw you published one recently on LinkedIn, but the bullish and bearishness, I think you had a distribution, and I think it was individual sectors, and on the distribution was whether they were bullish and bearish. Is that all derived from the point and figure chart as well? Or
Yes. That was a sector bell curve. And that's another way of kind of looking at the market from a different lens. And it's looking at the percentage of, every sector we measure in terms of whether it's bullish or bearish. And we color code them for, very easy reference.
Yeah.
And then we plot them in terms of along a horizontal axis, which is, the right being more stocks are bullish than bearish, and then the very far end, the left, would be those that are more bearish. So it gives you an idea of sense of what sectors are performing the best, which are performing the worst. Yeah. And also the distribution of the curve itself will show you kind of the context of the market. So if the curve is very skewed to the right, that's generally a healthy market where a lot of sectors are working well. There's a lot of positive breadth in the market, and probably most likely, the market is in some kind of a rising phase. But if we look at a sector curve where the distribution is very skewed to the left, that's a market that's probably under distribution, some kind of selling pressure. In fact, after, market crashes where, like if we had like in COVID in 2020, for example, you'll see examples of where the entire sector distribution curve is on the extreme left axis, almost vertically stacked, because everything widespread got sold. So those are extremes, but it gives you a way of just looking at the market from a different lens, and it kind of gives you a sense of the health of the market.
Yeah, very good. And the bullishness and bearishness, um, what's that? Sorry, what's that derived from? Or how do you label it, bullish or bearish, or is it kind of a
Yeah, so
bespoke?
that is that we're measuring. So let's just say that we'll just pull a number out of the air. There's 100 stocks in a given sector. We're going to look at what percentage of those are bullish on a point and figure chart. So that would be on a buy signal and a rising trend for simple definition. So let's say 60% of those meet that definition. So and when a stock triggers a buy signal in point and figure, it only gets counted once. Like it could generate multiple buy signals, but you only count it when it triggers it. So you're getting an accurate sense of how that bucket of stocks is divided between those under control by supply and those controlled by demand. So if you get a 60 or a 70% reading, that's telling you that the vast majority of the stocks in that universe are bullishly controlled. So they should be rising. So that's generally a healthy sector. If you only got 20% of the stocks in a given sector, that would tell you that it's a very weak sector.
Yeah. I love that, because someone as successful as you, I think, using something like a point and figure chart, when I feel like these days people are always searching for a very new, overly complex methodology. But you took an old concept, made it rules based, and it still works well for you today, which I think is the key. Right?
Well, I think the problem is when you get into rules based, I think one of the issues is that you can overly optimize. I'm actually even fearful with AI today that we're going to have overly optimized backtests because AI can, with all of its capabilities, it can go back and look at historical data, and it can certainly determine what was the best factor set and create these beautiful curves.
Yeah, yeah,
But that is not representative of what's going to happen in the future, most likely. And I think we're going to have these overly optimized backtests that are not really replicable. And I think there's going to be some danger in relying on those. I would much rather have a simpler rule set where the factors are easily explainable. It should be universally available no matter what the environment. I mean, supply and demand is pretty universal. And so that's the point and figure charting. And momentum, numbers of white papers on momentum, and it's really just the way of defining price. Um, Price could be moving for a whole variety of reasons, but at the end of the day, we're measuring price. I think if you just limit factors around some of these really basic concepts, and then not try to optimize all these other possible variables that are probably never going to be the same, then you're probably much more likely to be successful and have something that's going to be more predictable of future results.
yeah,
So
yeah. That's the concept of kind of having a reason behind adding things into a system, I think, is interesting. A couple of guests ago, I had a guy called Travis Wu on, who was working with a developer, and the developer developed the system. Super smart guy. He said he was like a rocket scientist, and he built this system, and they had no idea how it worked or why it worked, but it had super great results and everything, whatever. And he launched it, and he said it hit its max drawdown within 2 weeks. Its max historical
mhm.
drawdown of 40 years. He said he lost 20 grand on the after a
Yep,
month or so, and
yeah,
yeah, simply because it was overfitted, as you said, and there was no reason for why it would
yeah,
work. It just did, and then it just didn't. You know what I mean? So
right. I mean, something I'm really proud of is the fact that a lot of the models I developed around 2006, 2008, in that era, I mean, they've had an incredible amount of out of um, out of box sample data now, right? I mean, we've had, when we built them, we were using in sample data. And now we've had a lot of, years of actual performance and out of sample data. And the consistency of the models, they've all stayed pretty true to what was. I've only had a couple of instances where I had to go back in and really kind of look at the rule set and question why it was beginning to deviate a little bit. But, now that's going back, nearly 20 years. And so, um, and that's from pretty simple rule sets.
Yeah,
So,
not bad. Yeah, once in 20 years to go back is pretty good. But in that interview you had on, I think it was a max convexity
mhm.
channel. Um, I think I can't remember his name. I think it was Rob, the guy you were interviewing with. Was it
Yeah,
Rob?
Robbie, he's the is the owner of Accruance
Hmm.
US, or the hedge fund that we, or not the hedge fund, but the ETF that we're involved with.
Yeah, I think he said one of the things that attracted him to you was the way you back tested. And I'm getting a little bit off topic I originally asked, but I want to ask anyway. So, I mean, what makes a good back test for a bus? Because I'm about to use a backtesting software and so you buy a license for or whatever because my development skills are poor to useless. They're okay, but they're not enough to that I'd be willing to. Basically, I'm happy to outsource it, but I'm worried now that if I use this backtesting software, I'm going to look like the best trader in the world on paper, but in reality, I'm worried it'll be an overfitted backtest. So, what can I do to make sure it's robust?
I mean, I would urge you to go in and look at what the factors are, and then question why those factors are there, and what could be things that are influenced. Like, again, we were talking about this prior to the interview, but it's the idea that there is no strategy that's good all the time. There's no perfect system, right? And so you have to have, different strategies, different systems, but in the key is understanding the context, the macro,
Mm,
you know. And so are things that you're optimizing to, you know, um, favoring a certain macro environment would be one thing I would consider. Um, if we use like momentum, pretty universal, and if we use momentum with absolute momentum, which now helps filter out periods of negative performance, that's a really simple factor, but it's also easy to explain. But I don't think it's ever going to really change because we're just measuring price movement. And we basically want to own things that are strong when the markets are strong, but because of absolute momentum helps us minimize those periods when everything is negative. It can also tuck us into something that's safe when we need to be.
mm,
And that's why I feel very confident, like if you're using a model that's mathematical and you understand how those rules get you in and out of different securities and why, um, like in the context of absolute momentum, I feel like there's no way in heck you would ever ride through a bear market because mathematically it just wouldn't allow it.
mm.
I mean, cash assets would, suddenly be at and I've seen this many times when markets go through protracted periods where a ranking score on a cash or, like a money market or a T-bill or whatever, or if you want to use ETFs, you can use something like SHV or SHY. Um, those will rank higher than sectors or indexes that are stock based. But there's a reason because the environment is not so good at the moment.
Yeah.
So I would just go back to your question. I mean, I would try to understand why it does what it does and not
Mm.
just take it on like it fit just well.
Yeah. Okay. I will do that. And momentum I'm familiar with, but when you say absolute momentum, how does that work? Or can you give me an example of how that works?
Give you a metaphor. So momentum, and again, dozens of papers written on it. Even Eugene Fama and the French model they introduced in the Chicago School the idea of momentum, and it's really just price movement. So imagine we've got 10 racers, 10 sprinters, and they're all lined up. The gun goes off. They all run down to the other end, and we're just going to rank them. Just person number one, he did first place, second place, third place, whatever, all based on fastest speed. That's momentum. We're
Mm.
looking at the fastest racer on the track.
Yeah.
Now let me give you another piece of data. Imagine those sprinters, those racers are on the deck of the Titanic. Does it matter? Because they're all sinking. And so the point of that is that absolute momentum becomes a filter to understand context. So momentum defines relative momentum, defines the relative performance between security A, security B. And it's often used in sector rotation strategies or other, other ETF basket strategies. And it's just a way of separating them mathematically based on performance. Really simple. But the absolute momentum, I think you got to have it in there, and I do. It's something I just would never not have. Is it looks at it in terms of, well, is that performance, positive or negative? I mean, you can have, the sharpest falling knife, but I don't want a falling knife, right? I don't want to have losses. So if I put in a factor of positive momentum, absolute momentum, I'm basically comparing the performance of that security to itself. In addition to relative, I'm also comparing it now to itself. So if that performance of itself is negative, I don't want it. That's absolute momentum. Gary Antonacci, I actually was starting to use this in 2006, and it was kind of, no one else was kind of doing it. So I was like, I was seeing anyone else using it. It makes sense, and it worked. And then in 2012, actually, there's a white paper from Gary Antonacci on dual momentum, which was the exact thing. It was basically this idea that you've got two momentum scores. You've got the relative score and you have the absolute score. So what I do today, I actually bake it into the models. I will put an SHV. If I'm doing a sector rotation strategy, even though that's equity biased, I will put something very defensive purposely in there. And there's going to be times when that's the top ranked security, or it's the number two. And when I see that, if I'm comparing a basket of securities and I see cash is like number one, number two, even number three, that tells me that's probably a 22 kind of market or a 20 market. It's probably a very defensive period that I don't really want to have a lot of equity exposure. So that's a really simple way of putting in a mechanical process that I don't have to think about, that's mathematically defined, that measures and contains my risk. So absolute momentum is absolutely important. I mean, it's just really, really important in the work I do.
Very good. Yeah, it's good to know. It's a new kind of concept for me, although it makes sense, which is always a good place to start. Now, I want to get back to Drawbridge Strategies, right? So, what was the motivation or drive to become the founder of Drawbridge Strategies?
Well, back in 2000, so I had my own practice. I was an independent broker through, at the time, it was LPL, which was, that's now, I think, the largest independent broker dealer in the country. And in the process, I realized I had a real passion for money management. And so I actually went through the process of selling that business because I wanted to go into more institutional. And I actually we actually ended up merging the firm that I had built with a gentleman who had kind of come from the corporate world and had been building kind of a family office for kind of mid-wealth. I mean, the 500,000 to 2 million, 5 million range of clients. And the idea was to bring kind of the services to them that was only available to institutions or into the very ultra wealthy. So more of a family office kind of a setting, but not necessarily those same wealth levels. And so in the process of that, I became the CIO, and we actually began using some of these early sector rotation, style rotation, country rotation kind of models that were ETF based. And then I began applying momentum to dividend stocks, which I still do today. We took dividend achievers and overlaid it with momentum. And that was a way to find the top performing dividend stocks. And it worked really, really well. We actually rolled out a separately managed account program that ended up being used by several broker dealers and other, financial advisors.
Yeah.
So that was kind of the early days of it. And so the idea was, I was frustrated in 02 and 03 because we got through 01 pretty well unscathed. I mean, we had like a 3%, composite rating for our firm in terms of our portfolios. But yeah, you would go to the gym and you'd hear people complaining like my 401k is now a 201k, and people were just afraid to open their statements. And it was a little, and there was different other experiences. We had one client in particular that came in the office, husband and wife. He had owned a dental practice, and they had plans to sell the practice and move and vacation more. But time the account got to us, their 3.4 million was less than 2, and it's one of those moments like the woman's breaking out in tears, and it was like, oh, this is horrible. And so there was this frustration in me, like it felt like we were helping a very limited number of people in our office, but the question was, how can we help more people? So I actually thought, well, I'll start publishing models. I had no idea it was going to work, and I really didn't even know what I was doing in terms of like web and all that. It was just like, okay, I'm going to publish models, and it, in the very early days, it was kind of crude because I didn't know what I was doing in terms of becoming a web publisher. But lo and behold, people began subscribing and using the models, and it started to work. And so that just kind of morphed into what became present day Drawbridge, which really is, there's really kind of 3 layers of service. There's individual investors can actually utilize the models. There's financial advisors who use the models to run their practices on. And then there's kind of a more elevated version of that where we actually function as like an outsourced CIO, and we do much more of a partner. We'll facilitate both money management, trading, even some of the marketing. We've got a partner now that can do fractional CMO, so fractional marketing. So we got both fractional CIO and fractional marketing now. And that's one thing that a lot of advisors struggle with, is the marketing side of it as well. So we teach how to communicate and differentiate, because to consumers, financial advisors all look kind of the same, and they use a lot of the same language and a lot of same money managers and all that. So, no surprise, they do look the same, sound the same. And we kind of teach this approach. It's like, there's a different way you can compete in your market and really elevate your practice. And it works. And I've had so many advisors say, they'll come to me and say, gosh, you're right. It's like I started using this way of describing it, and these clients were saying, well, gosh, I've been looking all over for you. Like, where have you been? And it's just a way of repositioning around risk management and how you talk about return streams and those kind of things. And it's a different approach that a lot of advisors don't do. So,
yeah. And do those advisors also use your models, or is it, yeah, and institutions as well?
Mm-hmm.
Oh, very good. Yeah, and I guess those kinds of models I'm now interested in, right? So I mean, for a lot of people, they kind of have maybe some very basic but good kind of investment principles. Well, not most people, some people. Dollar cost averaging index funds. I guess if for someone like that was just say, buying the world and holding it forever, how could you approach their investment philosophy and improve it with what you've learned from systematics?
Wow, there's a lot to go after there. Well, first of all, I think it's really important for investors to understand that today's indexes, the popular ones, the S&P 500, the Qs, whatever, you're basically accepting the size factor as your investment factor. Like, we could strip out 60% of the S&P 500, vast majority of the left-hand side of the curve, return curve. You wouldn't even know it was gone, because the top stocks, the $1 trillion companies, the behemoths, the FANGs, your Googles, your Microsofts, your Amazons, your Netflixes. Those dominate. That's 30% of your performance right there in just those handful of stocks. And then the next little segment contributes the vast majority of the performance. So you're getting a massive, massive size bet when you take on, say, an S&P 500. And you're in today's environment, you're taking that size bet when some people are calling into question. I mean, we clearly are from a valuation point of view. If you're looking at various price metrics, Cape Shiller, whatever you want to look at, low dividend yield, high valuation market. So you're taking this bet that those size will continue. And I read some interesting stuff over the weekend. Like look at Apple. Apple now really hasn't introduced a whole lot of new stuff. They're kind of maintaining the old. So the innovation, and you got to understand. I mean, this is not anything that hasn't happened before. Companies go through vast periods of innovation. They grow, they expand, but then it gets really, really difficult. You can't just keep that up when you get to that size. And so one of the concerns is that what happens when the behemoths of today no longer are growing and at the pace they've grown. Yet that segment of the market, I believe the PE on that FANG basket somewhere around 36x, which is, now true, the rest of the market is trading about half that. But the half that part of the market right at the moment doesn't account for very much of the performance. That's the problem.
Yeah.
So you could have contraction in the FANGs at the same time the other companies are doing okay, but it's going to mask the performance because they don't contribute enough of their performance to the overall index.
Yeah.
So that's one of the challenges in today's environment. Like pick your indexes really, really careful and understand what you're picking. So there are equal weighted indexes. There's an S&P 500 index, which is X, the FANGs, like your S&P 490, I think it is. Which actually this kind of gets into a very interesting, I think, part of the discussion about rules-based. So in 2015, Andrew Lowe, who was a distinguished professor at the Sloan School of Business at MIT, wrote a paper, What is an Index? And he had really three criteria. The index had to be transparent, like you had to be able to see what was in it. It had to be 100% rules-based. It had to be basically nothing subject to judgment or special investing skills. So it had to be empirical. And then it had to be investable. And this is something I think is often missing. There's a lot of white papers out there that will discuss these great strategies, but when you go to try to implement them, it's either impractical or next to impossible, right? So I've always kind of favored those that are using liquid stocks, and I mean there's a lot of stuff that's out there that's has to do with small caps, and when you actually go to start applying it, it's like these things trade by appointment. It's like you can't do it. Certainly can't do it institutionally. So anyways, that was kind of the definition of an index. Well, he also makes a reference in that paper that if you don't hold yourself hostage to market cap weighting, then he calls that more of a dynamic index. And this is kind of where I spend a lot of time these days, because I think that everyone has adopted, either MSCI or S&P type of indexes as their index strategy. But nothing says that has to be your index. The indexes that we publish on Index One, which are live running real-time indexes, meet all these definitions. They're transparent, they're investable, they're rules-based. They look nothing like these S&P 500 or MSCI World, which are capped because they're all taking size bets S&P 500 is taking a size bet. MSCI World is taking a size bet. But if we can put together rules-based strategies that might harness yield or might harness momentum or maybe a combination of the above, we find you can actually, like, for example, the index that we put into service in this ETF that you saw us being interviewed for, that index returned mid-30s last year, around 35%.
Wow.
About 10 points over the S&P. And was it cap weighted? No. We blend yield securities and momentum securities, and we put momentum over yield securities. 100% rules based. It doesn't run by, we don't sit around in the beginning of the week and think it's all rules based. There's a lot of different indexes. We have my partner who I work with on these projects, they have a European index, which is way above what the Eurostock indexes are performing right now.
Yeah.
I've got a momentum stock. Now, you couldn't necessarily use this one in institution necessarily because it's only a 10 stock index. But if you look around in some of our strategies, we have this thing called US Focus 10. 10 stocks selected from S&P 100, selected on the basis of momentum and volatility. So it's rules based. We're basically saying it's going to be top performing on momentum, and we're going to use the volatility filter. And what the volatility filter does is it will trim size when you get a lot of volatility, but you're not getting enough return for that volatility, you probably want to have smaller size because you're not getting enough return payback. So it'll automatically trim your portfolio size, your position size. But that index, because it's concentrated, it's only 10 stocks any given month. And it's been running live, and the number's going to sound crazy, but it's like a 24% return with like a 22% drawdown. And so this idea of what an index is, I would encourage everyone who listens to your podcast to think outside the box. Like, you're not limited to, as Andrew Lowe talks about in his paper, it's like, if you venture outside of cap weighted structures, and I think that only became popular because of portfolio consulting and those some other reasons, but it's like if you venture outside and pick a different index, you can get a completely different performance, often better.
Yeah.
So anyway, it's consider other indexes other than the popular indexes. And I think you can do better.
Yeah. And you know what? It's not something I have considered. And I wanted to ask about that 36% return versus the S&P, for example, which was 25% last year. What was the risk-adjusted return or ratios like the Sharpe? Again, how did your index perform on risk versus just return?
Our drawdowns in those strategies, well, I'm going to digress for a minute. And I think it's part of how you pick good systems. And you raise a very good point. When I'm looking at a system, the very first things I'm looking at are things like max drawdowns and Sharpes and Sortinos, because those define the experience. Like, I can't tell you how many times I've been shown a system that's got this phenomenal number, but then you look at the ride, and it was these roller coaster, and I find most investors never want to go through that. I think psychologically, emotion is one of the things we're trying to eliminate. And what I've discovered is that if returns go negative too much, and by too much over 20, most investors start to check out. They can't handle it. And it's no fault of their own, because it's just the way we're built. I mean, our primitive brain has this, fight or flight.
Yeah.
And when the pain gets like that, you're just like, I'm done. And that's why Dalbar, who's been publishing investor results for decades now, Boston-based Dalbar, it's never different. The results are always the same. Like, people are their own worst enemy. And they make emotional decisions. And so part of the reason I'm so adamant about rules-based is like it eliminates or helps reduce emotion. You get rid of emotion and investor returns go up. But a lot of investors just can't get out of their own way. And it's just because of the way we're wired. It's not like it's a fault of anyone. It's just we're wired this way. So when you recognize that and you say, well, okay, I've got to get rid of emotion. Well, how do I do that? Then I use rules-based. Now, in terms of rules-based, I have this idea. I actually wrote about this. I'm actually going to write about it again because it's been a long time. But when I'm looking at a system, again, I go look at drawdowns. It's like the first thing I want to look at. But I have this idea that a good system is very symmetrical, and I call it kind of the butterfly effect. Like if you look at a butterfly, dead down the center, perfectly symmetrical on both sides, left and right. And the way I look about, and when I'm thinking about a system is like, if I'm looking at a system that has like 10, 12% compound annual growth, I want my max drawdown to be not much more than that. But think about the S&P 500. S&P 500, we're promised a 9-10% return over time. But what happened in 2008? We had a 55 down, very asymmetrical negative. Well, there's not a butterfly in the world that would get off the ground if one wing was 6 times bigger. Just wouldn't happen. So investment strategies, I think, need to be symmetrical, and oftentimes they're not. So I'm always looking for strategies, and stuff that I'm designing myself is like I demand that the drawdown be kept as small as possible, and certainly not much larger than the return side. And that gets into compounding, because everyone talks about the miracle of compound growth or whatever. It's a fantasy if you don't control losses, because look at what happened in 2000. You went through this, they call it the lost decade for a reason. I mean, really, it was more than a decade. It was like 2012, I think, was when the actual break even was. It's not only the loss. So if you lose 50, you got to get 100 to get back, or if you lose 20, you got to get 25 to get back. There's that asymmetry between loss and required loss to recoup it, or required gain rather to recoup it. You also have that time, so you lose time as well, which you never get back. You might get your money back, but you never get the time back. And that to me is, if you're planning for a retirement at a certain time, that's critical.
Yeah.
And I think it's a really important point that not enough advisors plan or build around. But back to your original question. So the drawdown in that system is like 2022 max drawdown. So it's keeping that symmetry. So if we got a system that's compounding at around 24, then the drawdown's been about 2022. Most of my systems that are ETF based are more around that 10, 12 with a 8 to 10 kind of drawdown.
Yeah.
Most clients I've discovered have, individual investors can experience an 8-10% drawdown and deal with it pretty well. Get around 20, yeah, you're going to get some phone calls.
Yeah.
So it's just, again, human psychology. So anyways, I think it's really important when you're looking at systems to think about it in terms of symmetry between risk and reward. And I think, again, just the popular approaches like, the current indexes, which don't really have risk management built into them. It goes, there's a definition of gambling. Gambling is betting on an uncertain future. That's the definition of gambling. So if I said, okay, we're going to buy the S&P 500 index fund today, I'll argue that that's gambling. None of us know what the future is. It may be enough. It may not be. We don't know. I would much rather use that same S&P 500 index fund if I'm going to use it, but I'm going to put some rules around it. I'm going to put some rules around it, why I'm going to own it, when I'm going to own it, when I'm going to sell it. And I can control that, because now I have a defined process. I have a known process that I can put around unknown data. I don't know the future, but I know my process, and my process is never going to change month after month.
Yeah.
So if I'm using this definable process, which is known, I can manage that unknown data. And that gives me a way to then control downside.
Mm.
I don't want to take the risk of a 55. Just doesn't work for me. It doesn't work for a lot of investors. It certainly doesn't work for someone who's retiring and then they lose 50% of their portfolio.
Yeah.
I mean, they may never recover.
Yeah.
So,
Wow. I think that's awesome advice. You remind me a little bit about Tom Basso when I spoke to him, and we talked about filling in the potholes. But you've
mhm.
just kind of your approach in my head, the way I see it, is you fill in all of the potholes in advance and then create the index that has no potholes. As opposed to when I was talking to Tom, he was thinking, right, buy and hold, you will have these elements of drawdown, and then you offset by buying another strategy that wins in those times. But the idea of creating an index that's managed that already, um, I think is really great.
Yeah, I mean, again, there's no perfect system. And so you have to understand what the Achilles heel is for every system that you're running. So,
Okay.
yeah, if you're using momentum-based strategies, then things that maybe mean regression is a complementary strategy to momentum-based kind of system.
Mhm.
And then you also have to be cognizant of the macro. And I remember in 22, I was writing about because yields were making a breakout to the upside, and I wrote a paper. It actually was a series of papers on the death of 60/40, and it was just based on this idea that um, if you're thinking that the bonds are going to be a safety net for your 60/40 strategy, we're guessing in because bonds are becoming a risk asset. In fact, in reality, they actually contributed more risk that year than the stock side did, and both were negative.
Mm.
So you have to be kind of cognizant of the environment. And so there's a paper, but it's the idea of a century portfolio that if you had to put together a portfolio and to step away from it for 100 years, you couldn't touch it. What would it have to look like? And the idea of it was that you would have long stocks for periods of falling inflation, falling interest rates. You would have things for inflationary, which might be more materials, commodities, gold, those kind of things. And then there would also be some volatility kind of strategies, which then this is what the part that's a little harder to execute in the real
Mm.
world. But you would want to be long volatility for those periods of time when the market is kind of declining. And so when I'm thinking about putting together systems, I'm thinking about it like, to me, like, what is not diversification? Well, not diversification is I own 100 stocks. Okay, that's all stocks. They're all going to fall probably roughly similar. Or I own multiple asset classes that are risk based. Um, Even things like Bitcoin today tends to be more of a risk asset.
Sure.
So when stocks are falling, Bitcoin, all those are kind of risk off at the same time. So that's not diversification. Um, I want to think about it more from terms of like not truly mathematically, not what's not correlated, and then what are the levers being applied? What makes a certain asset class do what it does at that time? And so I want to think about what macro environment we're in. And if we look at the macro environment we're in today, it's much different than what it was. I would call it the golden era. So from 1982 to 2000, there was this wonderful period of U.S. market history where you had extremely low valuations, PEs in the single digit, dividend yields 6, 7, um, bonds were at 14, and of course bonds went to zero. So we had falling interest rates, we had falling inflation because that was the globalization and the disinflation, and things got cheaper. And so there was all these factors that just made that just like this perfect environment. Well, that environment is not today. Like those events are not going to occur. We're at much higher valuations. I mean, we're the extreme polar opposite. We're at the lowest dividend yields, some of the most expensive PEs, and we have inflation and we have rising rates. So you can't go back and look at that data and expect that to be happening again now. We're in a completely different macro environment. And those are, I did those, I mean, those are two extremes, but just to draw the point that you have to consider the macro. But so where are we today macro? Well, we have rising rates. And the rates to me are is much influenced by economic activity because a lot of people are, looking at like, wages and jobs and those kind of things. But I think you have to consider in today's environment, we got a $36 trillion deficit. We've our deficits, our interest on our deficit is already about $1 trillion alone. If we don't get that under control, well, so what does that mean? It means we have to issue more and more bonds. So we have a bigger supply of bonds. But what's happening is like other parts of the world are buying less U.S. Treasury. So you got the supply demand imbalance out there. I think U.S. has been buying a lot of their own bonds. So they're selling on one side, they're buying on the other side, kind of artificially keeping rates suppressed. That's an issue though, because in inflation, if we look at the last CPI, and inflation was still around 3%, and the Fed's kind of backing away from their lower targets that they originally had. I think they're like, oh, maybe we're going to stick around here with around a little higher numbers. So you got this inflationary base. I mean, what people fail to remember is that, it's only 3% or whatever. Well, a dollar of goods cost $1.20 after you compound that over the last several years. And if you exclude food and energy, which is kind of a joke, right? Because consumers don't exclude food and energy from their month to month.
Yeah.
It's much, much higher, right? So it's the environment we are in today is definitely more inflationary and certainly more expensive. And I think that's going to dictate the kind of systems that are going to, thrive or not,
Yeah.
in the future.
Yeah, very good. As I said, you're one of the kind of few systematic traders I've met that takes into account the context, the macro regime. Like there's FX spot traders I've met that are only macro. There's hedge fund managers that talk about regimes, but systematic traders usually stick to, you know, very rules based indicators. So I really like that. And when you look at the macro, what are the main things you're looking at? What are your variables to look at?
Well, first of all, I want to make sure when we're using the actual systems, we are 100% rules based. I mean, we're 100% systematic. There's no subjectivity in terms of the outputs. It's like we're using exactly as the rules are defined.
But
But
are there rules? Sorry, are there rules for macro data? Is that what you mean, or
well, no, for the actual systems themselves. Well, if we're ranking or we're doing work on a basket of stocks from a basket of ETFs, whatever, then those are very defined. When I look at macro, I'm thinking about it more from the terms of like the context of what systems are going to, what are the levers being applied? Like if we're in an environment where equity returns are going to be subdued because of, um, we're in maybe a period of either economic contraction or just, for whatever the reason. In 20, it was COVID, but it doesn't really matter what system you're going to be using if you're trying to extract return from S&P 100, 500, a basket of sector ETFs, whatever. It doesn't really matter. I mean, we're in this environment where you can't pull the rabbit out of the hat. There's no magic you can apply. It's just we're in this environment. So you have to, where it does, it helps set expectations. It also might, though, give you, like if I see, the way I think about it like this, if I see natural resource doing better, then maybe I want to allocate to a heavier weight to a strategy. It's not that the strategies I run necessarily all that different. I'm using a lot of similar rules, but it does determine how I might allocate among the strategies, if that makes some sense.
Mm.
Like if I see risk off, I have some quantitative stock screens that I run. If I see risk off, then I'm going to pull away from things that might be beta driven, small cap, higher aggressive. I don't want as much exposure. Now, some of the strategies will automatically be going to cash anyways, but it kind of how as I move the chess pieces around on the table, I don't want as much exposure to beta if I'm going to risk off. And when those indicators click back to risk on, okay, now I'm going to go buy my more aggressive strategies. So that's kind of how I think about it. So there's kind of this framework of risk on, risk off, and then there's kind of the context of, inflation, deflation, those kind of things. And it's really, I don't necessarily put weights on those, but it's kind of it does help me apply again the kind of strategies that I want to, because some strategies will thrive in certain environments and others not, right?
Yeah.
So it helps me decide which strategies I want to allocate more attention to.
Yeah. And I guess the risk off, risk on kind of dial. Say take risk off, for example. How do you know we're in a period of risk off? Is there certain things that flash red on your screen? And
Yeah, so I actually put this on the Substack, and I do this mostly for free on that part of the Substack. So I measure a lot of it is like on the U.S. markets, where I have the data for. I don't necessarily have that data for European markets, but I can measure that internal supply-demand imbalance, and it's given throughout the years some really insightful turning points. For example, right before COVID even became in the news, I can show in January and early February, institutions were clearly coming out of the market, and it triggered a sell signal. And it was like a month later when COVID kind of finally hit the news. And what's kind of interesting also about that was that in March 20 to 24, in that period, institutions were piling in. They couldn't hand over fist. They couldn't buy it fast enough, and it showed up in those indicators. So that was kind of giving me kind of a risk on. And so there's some turning points like that where it's been really, really useful. More recently, like in the last couple of months, so early December, we got a risk off, like around December 3rd, December 4th, and that kind of led to that decline that we initially had. We have flipped back up, and this last month has been challenging from the viewpoint, like the market hasn't gone anywhere really now for 2-3 months. It's just chopping back and forth.
Yeah.
And so the risk you have in an environment like that is, I generally will honor you. Because I don't know what, is this going to be a down leg of significance or not? We don't know. So usually honor the risk off and you trim back positions. And when risk goes back on, you put some chips back on the table. But these indicators just kind of tell me again, what's the supply demand pressure within the market. So
yeah,
but those are available on the Substack.
And that's driven largely by the point and figure kind of foundation.
Bullish percent, yeah. Except I don't use it as a point and figure. I'm using it as a data point that I manipulate separately. It moves faster and it gives me more accurate. It actually becomes more of a timing indicator when I use it the way I'm using it.
So. Oh, very good. So you kind of taken it and adapted it a little bit to. Nice.
Yeah. We started that like almost 20 years ago. Yeah.
So that gives you your kind of overall, maybe I'd call it bias or on direction, and then we go into the rules-based strategies, or that's how my brain works. Is kind of the direction, then the strategy. So when you're coming up with strategies, what's your kind of go-to toolkit then when you're looking at, okay, I want to come up first of all with an idea. We talked a little bit about the yield and momentum idea, but when you're
Mhm.
just looking at a blank canvas, thinking, right, we're heading into this context, I have this risk on signal, maybe, for example, where do you go to first?
I don't think you have to. I mean, we all have probably. I mean, we all have the same tools, right? We all have
Mm,
exposure to the same securities, and something I really believe. I mean, I consider where we were when I first got into the industry and the tools in the cost structures that we have today. I mean, I don't. There's no time that an investor has ever had it better. I mean, you got cost of trading of zero, and through ETFs, you can manage every asset class from every different direction. Now we even got Bitcoin and ETF and those kind of things. So there's truly nothing you really can't touch. So it's really kind of just staying in tune with the markets. Um, and I think I know Meb Faber talks a lot about home team favoritism. Like U.S. investors tend to favor U.S. market.
mm,
Um, and it's certainly from a size point of view, it makes sense. Um, but if you look at like our European index this year, it's done very, very well. And it's like, so I'm kind of looking at it in context of like, what are the pieces that we have to work with in terms of what strategies, which are built either around sectors or styles or countries, those kind of things.
mm.
So I do have a commodity model as well. Um, and then if it's risk on, then I pretty much want to maintain, my exposure to like my U.S. Focus 10, which is the 10 stock S&P 100, or I want to own, uh, maybe sector or something style driven. That's basically being identified as like what's driving returns at this given moment.
Yeah.
The uh, and sometimes it's a combination of putting together, like we can create our own synthetic 60/40s because I've got an enhanced income model, which is basically I use AGG as the benchmark. Returns are about double that with about half the risk of AGG. So we can create our own custom 60/40 kind of blends. There's some variation of that if a client needs that.
Yeah.
Um, so I kind of think when I'm building portfolios, I'm kind of thinking more of it kind of like from a viewpoint of an endowment, or I want to put together multiple streams of return.
Mm,
The more non-correlated they are, the better.
yeah.
In a lot of environments, though, a lot of things are highly correlated. You can't totally escape that.
Yeah.
And then always, though, the key though is always having risk management in place.
Mm,
Like I mean, these systems all have their own ability to go to cash. And what's interesting is that during periods of contraction, I might have a portfolio that's got 7, 8 different separate strategies, but they're all starting to move to cash around similar time. And suddenly you look at your portfolio and you're like, you got 60% cash sitting in there. And it just happened automatically. It's mechanical. It's all these systems start firing off, risk off around the same time. It's like,
mm,
okay, you just go with it. You don't question it.
yeah. And how do they all have the same built-in risk-off triggers? Is it, or
Similar. A lot of
yeah,
them have
so,
similar. I use it. Well, a lot of them are running some type of an absolute momentum kind of overlay,
mm,
which is why you see those signals. But it also speaks to how closely correlated many strategies are, or how not so much strategy, but how closely correlated asset classes are.
yeah,
So,
yeah,
and actually, something I do, I don't necessarily run it as a model, but I publish it often, is a look at all the broad asset classes. And I go a little deeper than I might include things like preferreds and MLPs and other more less mainstream asset classes, but I'll actually show them ranked to a risk-free asset. And it's kind of interesting because there are going to be times when that cash is sitting right there at the top. And that's
mm,
usually like a 22 kind of market or something. But I think of it like an accordion. It's like during periods of risk, when the asset classes expand, there's more asset classes that are risk on that you can be safely invested in. And then periods of contraction, it's kind of contracts. And all of a sudden you got cash or T-bills or treasuries or bonds sitting at the top, and everything else is like, risk off.
Yeah.
And so, but the market just kind of cycles naturally. There's this rhythm between these two. And it's like that list gets smaller and larger, just kind of where we are in the cycle. But that's another thing I like from a very visual point of view, because I can look at that list and I pretty much know where we are in the market. And like one of the things that's happened more in the last year, particularly, it's been very narrow. You've had large cap mostly sitting at the top and not much else. And so it's like, okay, I mean, it's risk on, but it's a very limited universe of, where the return streams are coming from that are rewarding you enough for the risk you're taking.
Yeah. Thank you for that. And before we talked, or before we hit record, we talked a little bit about designing strategies and building in mathematical expectancy. So
Oh,
can you explain a little bit to for everyone, I guess, what mathematical expectancy is?
I'm glad you brought this up. Honestly, I think this is to me the most important part of running systematic or rules-based strategies. So as important as it is, very few investors even know what it is, let alone utilize it. Casinos are built on it. Insurance companies are built on it. Basically, the thing that they have is an edge. So a casino knows that, enough rolls of the dice, enough spins of the roulette wheel, that over the night, over the week, you're there, whatever, you're going to give away your money, just the way it is. It's mathematical, and so like in blackjack, you can counteract that, say, with card counting and whatever. But how do they counteract that? Well, they introduce extra cards, extra decks of cards. Mm. So they always own the edge. Insurance companies, actuarial, know precisely, pretty accurately, what to expect, whether it be catastrophic claims, death claims, whatever. They got it down to a science. So they know that they need to charge whatever that cost is plus an extra premium to be profitable. And they do. That's how their businesses are built. That's how Vegas was built, how Atlantic City was built, all on an edge. So as an investor, you can make a decision. Do I want to be the house or do I want to be the gambler? And what rules-based investing gives you is the house edge. So if I gave you, so let's just break this down. We know with a coin toss, probability of heads and tails, 50%. Yeah, it might streak. You might get 10 tails in a row, possible. But we know with enough occurrences, 100 occurrences, that it's going to be pretty evenly distributed, right? 50-50. That's the probability. So now if I said, hey, I'm going to give you $1 and a nickel for every time you won, and you're going to give up $1 every time you lost, well, the question is, how many times do you want to flip that? The correct answer is as many as I can, as fast as I can, because you own the edge. That edge will compound wealth over time. Has to. It's mathematical certainty. So what we want to do when it comes to investing is we want to use that concept of owning an edge in our own investing. And so when we put together, going back to what we talked about kind of at the beginning of the show, was when we put together systems with data, and the more data, the better. What we might see, and I'll just kind of give you an example of, some of the ETF systems that I run. You might see that the occurrences are 65-70% win rate. So the probability of a win on any given toss occurrence is 70% of a win. So that's the first piece of data we need to know. Second piece of data we need to know is what's the average loss and what's the average gain. And so we take the probability of win times the average gain, subtract from it the probability of loss times the average loss, and we can come up with what our expected gain is in any occurrence. Now, it doesn't mean that every time we show up and swing the bat that we're going to have a win. But we know out of enough occurrences that we should. That's what the data is telling us. One of my favorite movies, Moneyball, was based on mathematical expectancy of baseball players. What they figured out was that you could look at the data on a player and figure out his likelihood of being on base. It's really what Moneyball was all about. It was becoming empirical about, it wasn't subjective, like, oh, I think he's a great hitter and whatever. It was none of that. It was all mathematical. And then eventually that got adopted by all the other baseball teams. But that was how they valued players. And so you can value a trading system by the edge it gives you. And so it's kind of interesting too. A system can be actually profitable less than 50% of the time, as long as the average gain is larger or large enough to offset the number of occurrences of losses and the size of the losses. So you might have a system that hits a home run every now and then. Now, I don't personally favor those kind of systems. I like more consistency. That's just my own personality. That's, someone might be okay with that. But mathematical expectancy is something that I would want to know as an investor. Like if I'm trading a strategy, and going back to when we're examining strategies, we talked about looking at max drawdown. That's really important. But equally important is the expectancy factor. Like what's my expectancy? And what I have found since I've been doing this for so long is that it holds pretty true. Like if you got a system that says you're gonna make about $1.30 or whatever the number is per occurrence, it's about what you get. Because, and again, the more data you have, the more it just continues to smooth it out. But it's when you start to deviate far from the expectancy, I think of that as like guardrail. It's kind of like you're going to bounce from side to side of on a road. It's going to keep you kind of contained. It's those occasions when you go off beyond the guardrails that you're like, okay, I need to take a look and see what is happening here, because I shouldn't be doing that. So it's kind of a yellow warning signal. But expectancy is a mathematical definition, and if you use it, it's going to define how you're going to compound wealth. It's mathematically defined. It's not guesswork. And most people they don't use it, because if you're not quantifying how you're investing, if you're not using rules-based, it's impossible to define. Like if cousin Eddie comes over and says, hey, buy Netflix, how do you quantify that? You can't, right?
Yeah.
Or if you're using tips from, watching CNBC or whatever, none of that's quantifiable. It's only when you have that precise rule book, when the rules of buying and the rules of the selling are precisely determined ahead of time, and you precisely follow it. Now you got something you can actually build expectancy around.
Yeah, I love that actually, and I think it's one of the reasons why it's so hard when people start, is that they have no idea about how systems and strategies are supposed to behave. So then when it doesn't behave, doesn't print their money all the time, they fall off.
Yeah, that's the problem. Even though rules-based, system-based investing is supposed to minimize investing, and it does, but you have to be willing, just like you said, you have to be willing to sit there and go through what if we sat there through 6 occurrences that were all losses? Would you have the faith to take the 7th trade? Now, if you truly believe in the system, you will. But again, it's impossible to completely divorce yourself from human emotion. It's just we're just wired that way.
Yeah.
But it's when you become kind of emotionless and just look at it as, okay, it's just numbers. It's just it will take care of itself. I mean, it's you just have to become less emotional about the sequence. You have to believe in the sequence.
How on the topic of backtesting, measuring trades, and calculating your expected value, how do you pair that with macro context, right? So, for example, if you take 20 years of data and you apply a strategy, and that strategy has given statistics around it, but then we have say a macro context we head into where we think this, I guess it will be an expansionary phase and equities might do well. Or we've got Trump coming in and the macro is fine in the US, and say the technicals weren't a bit iffy, they were all systems go. How do you kind of find the right sample to compare that with, if you know what I mean? Or do you just take all of the data?
Well, a lot of either kind of gets into construction of a strategy. So, a lot of ETFs weren't available for data much before 2006, 2010. I mean, there's been a lot of new ETFs that have come on. So, what you have to do is then go back and use index or proxies. But you can build. There's certainly we can go back and look at data that has handled the 01.com crash. We can look at the the credit crunch in 08, 09. We can look at 2020. So we can a system that hasn't been tested through downturns, and it's only been available in that market. Well, okay, to me that doesn't have a lot of value because I don't know how it performs in the declines. If I'm building a system that's using these absolute momentum kind of strategies, I know mathematically how it should behave. Again, it's mathematics. It's like you can't change that. It's empirical. It is what it is. Yeah. So I have an idea of how it's going to perform, even though maybe maybe it didn't run the 87 crash or maybe whatever, but I know how it should behave.
Right.
But what we tend to do is we'll build around data sets. There's data out there. We can go back, 60s, 70s, early 80s. We can get data that is on more of index proxies, and we can translate that to, more current. Some of the newer ETFs. I mean, there's a lot of these newer ETFs which are very nuanced or very specialized. And those are a little harder to incorporate because we just don't have as much data on them. I mean, a rules-based system, you love data. The more data, the better.
Yeah, I think
that's the only way you can get a true picture of that mathematical expectancy.
Yeah, I think in my head when we talked, when we talked a little bit about context, I was thinking, would we find 10 years of data where the context on the macro side might be similar, and that would be your sample. But it sounds like, as you said, the more data, the better, because you wanted to see how it performs. I mean, because you could
I don't want to favor one versus another. Now, I might as a exercise go back and say, okay, well, how did it perform during a period of expansionary or contraction, whatever the period that we're interested in. Those are useful to know because they can then set up expectations or some guidelines. But I want a system that's going to be more robust in multiple periods of time.
You mentioned the edge as a concept and the house edge, and we create edge through creating trading systems. And obviously, if we talk about multiple systems, multiple asset classes.
Mm-hmm.
Asset classes aside, if you were to take one strategy to create your edge, we talked about not touching a strategy for 100 years, something like that, what would you choose and why?
Well, I've built some strategies around core, what I call core, and those represent like global asset classes. So US, European, Asian, just a variety of different asset classes in terms of equity. They might also include things like gold. They might include, obviously different credit instruments and so on. I'd probably pick something broad like that because we don't know where the next. I mean, we've had this period of wonderful U.S. performance, but I certainly wouldn't want to exclude the idea that maybe the next period favors international or even emerging market. So I'm not saying it's going to. I have no idea, but I'd want to have something that was fairly broad, that gave me ample opportunity to choose from enough diverse asset classes that I probably have a good chance of picking something that's going to, and it's going to be a degree of performance, right? If international is performing better than the U.S., it's not that the U.S. is performing negatively, but it's not black and white. But I want to have the opportunity to be in a top performing market. So, I mean, in what's nice about ETFs is like we can build strategies like these kind of core strategies are very easy to implement without even a lot of capital. I mean, you can run a basket of 3 to 5 ETFs on a month by month basis, really cover. Key is the starting universe. If the universe itself is broad enough, maybe you only own 3 to 5 on a given month, but if it's chosen from that broader universe, you can have a pretty decent shot at keeping pace with whatever is happening, economically, globally.
Okay.
And sometimes that might be sitting in cash or being defensive, but that's probably not a bad thing if that's what it's calling you to do.
Yeah. So you would pick kind of broad-based indices, and is it buy and hold a number of them?
No, I wouldn't buy and hold anything. I don't.
Oh,
Because that's just because my um, lack of desire to own anything that's declining
I
significantly.
guess, yeah.
So I would have everything set up to where it is rules based. So if it's a single system, I'm going to back up for just a minute.
Mhm.
There's some problems, like if you try to pack into a model all the asset classes, you would think this makes sense. Well, I'm just going to put together a portfolio. I'm going to start with US. I'm going to put international. I'm going to put emerging markets in there. I'm going to put gold, commodities. I can't lose because they're all in the basket and it's going to pick the best one. Well, here's what happens when you do that. The volatility of those asset classes is different. They might be closely correlated at times, but still the volatility is different. They behave differently. You get real estate and emerging markets are a couple of examples where you get a heck of a lot of units of volatility or risk per unit of return. So they behave differently. So if I'm put everything in the basket and now I'm going to treat everything the same, it's not really the same because the way they behave. So you're really better off taking asset classes that perform kind of similar in terms of, I look at volatility. I want higher. The way I do ranking, I don't know anyone else who really does it this way, but I don't rank every asset class the same. I rank asset classes based on their volatility, meaning that a highly volatile asset class over the course of typically a shorter span of time will give off as much risk as maybe something like healthcare sector. I might be in healthcare sector for 6 months or 12 months. In the units of risk that it we think of it as a score, the units of risk that's coming from a sector that's more stable is a lot smaller than the units of risk I'm getting from an elevated risk asset class like emerging markets or something. So what I do is I think it's a problem when you try to universally apply the same set of rules to every asset class. It doesn't work. I mean, you get some result. I mean, they're not going to be as good as you could get doing it by separating them. So I think it'd be hard. I mean, okay. I mean, there is that portfolio I talked about from the Century portfolio written by Cole from Artemis, a hedge fund out of Austin. They write about owning stocks and bonds and volatility and commodities.
Yeah.
So now you've got inflation, deflation, all these different macro aspects covered. And they had to step away from it for 100 years. I think that's going to probably give you, some single digit number that's probably better than cash, but I don't know. Could you do better? Probably. Um, I'd rather have the opportunity to take a few buckets, maybe not a lot, but a few, separate them, run independent systems, and then put them all together and say, okay, this is your portfolio. Because it's really hard to compress all the asset classes into one bucket and then treat them the same.
Yeah. Okay.
Because there's not a set of rules that universally applies evenly to every asset class. If that makes sense.
Yeah.
I mean, trend following. I mean, the most basic. It's used by a lot of CTAs. Meb Faber wrote a paper on quantitative investing in 2006, which was basically a moving average system. It was like, I'm going to own the asset classes that are above the 10-month moving average. And you could substitute that. You could substitute 6 months. You could substitute. It's really just a line in the sand, really what it amounts to. If you look at moving average systems, the big thing they do is they define a hard stop of when you get rid of an asset when it's starting to fall. And that's really the big thing that they do, and it keeps your losses small. Like in his white paper, I think the return when the S&P was down 55, his return was like 18 or negative 18 for drawdown. So mission accomplished. But the other side of the coin is that the compound annual growth of those kind of systems is much smaller because you're universally applying a system across different asset classes that behave differently. And the compound growth numbers are like single digit, 4, 5, 6s. When I've done trend studying on these major asset classes, I'm getting usually single digit. I can do better if I can apply trend plus momentum rankings or whatever. And again, then I start to build them so that I'm adapting to the volatility of that asset class, because again, they all don't behave the same.
Yeah. Yeah, it's a great point, actually. I think my question was oversimplified. So you said, we build rules for trend, maybe using moving averages, rules for momentum, and rules for volatility. And those can change per asset class depending on the asset class.
Yeah.
Yeah. Very good. I think that's a great takeaway, if I'm honest, for people, just as a core 3 things to approach a system with. I mean, each one, right? We have umpteen rules for how to do momentum and how to do trend, but if you take it as a framework, I think it's a really useful place to start.
Yeah, it's a framework, and then again, don't apply. Like one of the problems I see in momentum studies is that everyone's applying 6-month, 12-month universally, every asset class.
Okay.
And I can tell you from my work is that if you give a really highly volatile asset class too long of a look back period, the units of risk in those, it's just way too high. It's kind of like you're trying to the way I think about it is I'm normalizing to the risk. I want my look back period to normalize so that every asset class has the same risk level. So if that makes sense, I'm normalizing to a single point of risk as opposed to, well, this asset class has this much risk, this one has this much. It's all over the board. And so how do you put that together? It's, I mean, it's a little bit like risk parity, but it's not. It's kind of looking at like every asset class has got so many units of return per unit of risk, and I want to normalize to how much risk I'm consuming, if that makes sense.
Yeah.
Which we can do mathematically.
Yeah. So you've got kind of a risk budget, and then you have
Yeah.
return adjusted risk return unit per unit of risk, is it? Or how much
Yeah.
return you run?
Yeah.
Very good.
Because we want to minimize, like, like again, like at a market top, you get a lot of back and forth, you get a lot of volatility, but all of a sudden the trailing returns start to get smaller and smaller and smaller because you're not making any forward progress.
Yeah.
So now you should be demanding, like if I'm going to own that asset class, whatever it is, I want to get enough return to commensurate for the risk that I'm taking, which by my numbers is actually, in this example, it's increasing. So that's how those portfolios automatically adjust to starting to increase cash, because all of a sudden the return stream starts to get smaller. But we can do that on an asset class level too. So, and that's a way, again, how you get these automatic adjustments, which are just purely mathematical by design.
Yeah. That brings me really nicely to, I guess, a market being toppy to the current market, because I think, maybe I'm wrong, but I get the vibe you're quite cautious of the equity market at the moment.
Yeah, I mean, we are getting that by definition, where even if you look at what's happened for the last month or two, now into our third month, where we haven't really made any forward progress.
Yeah.
The NASDAQ is not confirmed. We've had the S&P make a high, NASDAQ has not. And volatility is expanding. So, and then I'm seeing my bullish percent indicators and some of these other internal things start to fade here a little bit. I think one of the ones I posted was the number of stocks above the 200, but I can look at 50-day or other moving averages as well, and those numbers are diminishing. So by definition, the percentage of stocks that are actually healthy at this point have been falling. The one thing that's been kind of a stickler in this market has been the advanced decline line has been pretty firm. The cumulative AD line has been weaker, but just the sheer number of advanced declines has been the one number that's been diverging on the positive side. But yeah, overall, I think, and then you take into account valuations and those kind of things. It makes me a little more cautious. Again, I run the systems, and the system, like our Focus 10 this month, it had actually a little less cash than it did last month. So I don't argue with that.
Yeah. There's one kind of thing I feel like maybe it's Trump has brought, is this kind of inbound volatility we've got recently. As you said, we go nowhere for 2 or 3 months. We kind of range bound, but it's not exactly been a nice, comfortable range. It's been
no. I mean, the last 2 weeks were characterized by, we had pretty much positive trend till Friday.
Yeah,
and then we had a hard Friday down, and that's happened now twice, 2 weeks in a row. So
yeah. So those kind of events, I guess, how do you position for them? Those kind of Mondays we get where it's like risk off on a Monday. We had that deep seek, and then we had, I can't remember what we had tariffs over the weekend. It was a little bit risk off.
I don't, that's a lot of that's noise, and part of the reason for using rules based is that it helps eliminate noise. You can mitigate, like a lot of our models rebalance around end of month, beginning of month, and I've tried a lot of different ways of adjusting for that potential risk. I mean, the fear of any momentum-like system is that, okay, you rebalance the beginning of the month based on trailing, because that's all data you've got, of course. And then, of course, you get a V on the second day of the month, and it heads completely down. And so that's the risk. You could time diversify. So you could take, you've got a bucket of money and you divide it into 4. And so now you're rolling a bucket of money every week. So now you're diversifying time a little bit. What I have discovered is that transaction costs, mental costs go up when you're doing those things, and the amount of return you get added is generally not, I've discovered, to be all that significant.
Yeah.
So things tend to work out. I mean, in the long run, the numbers all kind of wash out to where I've tried doing like beginning of the month with a mid-month rebalance. That didn't really add anything significantly. So I think, again, the more you make things complex, doesn't necessarily always help.
Yeah. It's one of the key themes I think I've got talking to you is, complexity and just the importance of simplicity, having reasons for adding things to systems and not just adding them for the sake of it. It sounds
Mm-hmm.
like is a key.
Yeah, yeah. I mean, the models are purposely, I mean, they're very purposely simple. The factor rankings we do, there's a couple levels of those. We do some that are, again, also very simple, where we might just rank first by yield and secondly by momentum. But we do some more quantitative ones where the ranking themselves looks at, might be several lines of code where we're looking at a variety of different, whether it be balance sheet items or cash flow items, whatever. And those are the purely hardcore quantitative models. Those are about as complex as we get, because we're looking for certain, factors to be expressed.
Yeah.
But the surrounding rules outside of that ranking themselves are actually quite simple. So.
Yeah. I mean, I guess as you put a system together, it gets multiple rules gets complex. That there are many of them, but the rules themselves seem to be not overly complex. Yeah.
Correct.
Yeah.
Right. I think the fear there is that you overly optimize, and then you have something that only works part of the time.
Yeah.
I'd rather have something that works most of the time.
Yeah. Yeah. Can you let people know where they can find you online, Tim?
Yeah. So our Substack that I write is No Excuses. And it's just, I guess, Google No Excuses. I'm certainly on LinkedIn. Google my name, you'll find me. And then I have a website, Drawbridge Strategies, where we publish some of our models. But we're putting a lot more effort into the Substack these days. And we have quite a bit of information out for free. And then paid subscribers get access to some work we do with dividend stocks, some ETF models, and introducing another portfolio here very soon. And we've also got a course. So if you really want to get into this, I've got a course on systematic investing that you'll be able to access the link to from the Substack.
Oh wow! So paid subscribers get also access to the course.
That'll be a separate, but
Oh yeah.
it's just I'm doing enough free information around it to, um, certainly a lot of basic information will be available for free. And then if you really want to roll up your sleeves and go deep on it, I've got that too.
Very good. Well, I think there are a few people in the systematic world that are, I think, as well read and well experienced as you. So it sounds like one to get in a world of kind of
Thank
courses
you.
that you probably shouldn't get. So good to
Thank you
hear.
very much.
Hey, and thank you for all your time. It's been a real pleasure.
Yeah, I enjoyed it very much. Thank you.